Okay, let's get started. I'm Jay Taylor. I'm the editor of Jay Taylor's Gold, Energy&Tech Stocks, and I host a radio show every Tuesday that airs live at 12 o'clock Pacific time on the Voice America Business Channel. And you can listen to the recordings the following day as a podcast at Jay Taylor Media or on my YouTube channel, Jay Taylor Media. All right, so I've titled my talk, 2020, Which Safe Haven Markets Will Dominate? And that's actually the same question I was asking last year, but I think there's some real good reasons to think we might have some extremely important changes in the major markets this year, and I'll get into that now. So the issue is, when times get rough, where do people go for safety? Do they go to gold or do they go to treasuries? Well, they certainly go to treasuries still. But there have been times when they haven't gone to treasuries, they've gone to gold. Last year, treasuries gained about 7%, gold gained 18.55%, but of course an awful lot more safe haven money went into treasuries than gold because the gold bullion markets are very small compared to the treasury markets. These are years when these are bear market years for stocks and bonds, 10-year treasuries, and the pink areas are the years when we've seen both stocks and bonds go down. So when bonds weren't particularly good as a safe haven. And the years when this happened, in most cases, gold did extremely well. Gold did very well during those time frames. Now, I think you have to keep in mind that ever since 1971, and when Nixon said we're all Keynesians now, it meant that the world had changed very dramatically from an idea that we didn't have to just leave the free markets decide things, but that government and central banks needed to intervene to make sure things went smoothly. And so what we've had is intervention upon intervention. We've had lower interest rates. Every cycle they go lower, and we're at the point now where in negative territory for a good part of the world. The red areas, this is a fairly recent slide showing the parts of the world and the durations where there was negative yields. Recently, there was something like 94% of all positive yielding investment grade bonds were in US dollar denominated instruments. So this suggests that there's money flowing into the U.S. as pension fund managers and the like. People try to find positive yield for their investments, for their savings. What this has meant is that there's no risk anymore in the stock market. You cannot lose by buying stocks. We know that's true because every time the stock market goes down, the Fed throws huge amounts of money into the system, and sure enough, the stocks keep going up again. However, there is a different idea about this. Michael Oliver, who's a very frequent guest on my show, I'm going to play now something that this is a short interview that I had with Michael on my radio show the first Tuesday of this year.
Seems like this is a year that may be quite exciting for those that are ready for it, and perhaps quite disturbing for those who are not. You've been talking last month or so, maybe longer than that, about two very quiet markets, namely the dollar index market and the commodity market as measured by the Bloomberg Commodity Index. And you suggested that those two markets are very close to a major turn of great significance, even though they've been kind of slumbering, sleeping, and not many people too concerned about them. Where do those markets stand right now, the commodity market and the dollar market? Do you see them making some major changes this year?
Yes, absolutely. They did it December. Mm-hmm. The December close broke below on the dollar index our long-term momentum support structure that the dollar index had used all during 2019. The number adjusted each quarter. So the lows in 2019 aren't the same on a price chart, but on the momentum chart, they were all at the same level on the off. That came out with the December close decisively. And therefore, we argue that the dollar is now shifted into downtrend. Now, it's not making any headlines at this point, but it's likely to make headlines soon. Meanwhile, at the same time, the Bloomberg Commodity Index broke out upside. Again, also a very quiet market. It's been quiet since 2016. And so nobody's paying attention to these two beasts, but they're big markets and they're major. Now, we think also their new trend direction will put wind in the sail of gold, which didn't need their help over the last year or two, but now has the assistance of those two markets to fuel its fire. Now, I caution everybody that the events that just occurred that sparked action out of oil, a dollar or so rally, it had already come up nicely recently anyway, but also caused gold to shoot up $40 the other night in the electronic market, up to 1590. Right now we're trading in the 1570s. But when news events like that occur, quite often it creates confusion, expectations, sometimes false moves. In the case of gold, I don't think it's a false move. It just got a little ahead of itself based on that news, and naturally there were sellers up there at $15.90, $40 up on the day, and it backed off $20, $30, and now it's firming back up again. So don't be disturbed by the pullback. It was an emotional moment, but in the direction that gold was already headed. Now, had gold been in a bear trend, which it's not, it's technically in a bull trend, such a rally should have been sold into. But in this case, the rally was legit. It just got a little too hot too quickly. Now, what I really like I'm seeing out there now is the stock market, because I think that's the next player as far as asset class movement that will help generate more upside in the gold market. The stock market is saying, beating its chest, saying, we don't care about that news. We're in good shape. And so, again, the sentiment level of the bulls, the forever longs in the stock market, has to be at about maximum, because they had this event and yet the market did not go down. So they think they're invulnerable. It's our view that probably the S&P is making a top right about now. I'm guessing, again, we haven't broken our numbers, but we have some specific layered numbers below the market that will indicate that, in fact, it is rolling over. But I suspect it's going to make its high, either made its high last week above 3250 on the S&P, or might make a new high this week, but watch it very carefully, because I think if you roll over from these levels, there's a good chance you're making the top. And there's a lot of trigger numbers below the market that are not that far below that will do a lot of technical damage. It's not necessarily apparent on price charts, but it's apparent on momentum charts. And if we upset that market, what will be the response of the central bank? Well, we know what the response will be. More of the same, except even more. We even have a president who wants to print. So combine that with the ECB, the Fed, and the BOJ, and you've got nothing but pro-printers out there. So that's going to help what? I don't think it's going to help the stock market. It'll create a river of liquidity, but the river of liquidity this time will go into the gold market, is our argument.
So, Michael, the issue here then is if money starts to flow out of the equity market, I suppose it also really goes into the treasury market. We're going to be talking to Alistair McLeod in the second half of this show today, and he's really concerned that we're going to start to see rising interest rates no matter what the Fed does.
I think the only threat of being short the bond market or expecting higher yields is that at moments when the S&P has sharp declines, mini crashes or a crash type event, you will have the natural panic investors rushing in to buy T-bonds. And so you'll have an upside spike or a drop in yields. But the damage that has already been done to the bond markets, I'm talking the Japanese, the German, and the U.S. government bond markets over the last few months, argues to us that we are probably in transition toward higher yields, with the caveat that if you ever get a moment of a dark moment in the stock market, especially its emotional one, you will have a rush back into T-bonds, but it will be a flare rally in the T-bonds, not a trend-changing rally. I think the bonds have a problem. Yields are going up. And that will leave one asset category out there, basically.
Yeah. That's right. Gold and the monetary metals, probably silver too.
Monetary metal.
Right.
Yeah,
and maybe to a lesser degree copper and some of the other metals. I mean, you're seeing a bull market entirely over the commodity markets, right? That's what you're seeing now.
If you're a smart investor and you look at the charts, you've had the commodities beat off the page as of 2016. They have gone down since then. They've gone sideways. Bloomberg Commodity Index. So they're not a bear. They're a sideways market. In our view now, they're up. But if you're a value investor and you want out of the stuff that is a bubble, you look over at the commodity category and you see no potential probably for downside risk. The issue is, are they ready for upside? And we argue they are.
All right.
So I think smart money's making the move already.
All right, so the smart money's made the move already, according to Michael. And December 28th, he put out a couple of charts. It was just a few days later that I talked to him. But if the dollar closed below 97.27 on the index, then it's in a bear market. That's his structural momentum work. And sure enough, it closed at 97.07. If the Bloomberg Commodity Index closed, if it closed above 80.89, or above 79.35, then it confirmed to him that we're in a significant commodity bull market. And so he doesn't see that interest rates are going to necessarily, in fact, he thinks we're in an uptrend for interest rates, and that's based on some momentum work he did last year, that we are really in a rising interest rate environment, and it's going to be that way for some time in his view. Now, if you buy the idea that we're heading into a commodity bull market, that certainly makes sense. But what are some of the reasons that this change, as I noted earlier, you can't lose in the stock market? That's the prevailing view. The Fed has your back if you're investing in stocks. And if you try to go short the stock market, you get killed time and time and time again. What could change that? How could the markets change? Well, this chart, and some of these, Eric did an excellent job yesterday explaining about much of what I'm about to say, but the idea that we have budget deficits that are growing during non-war and non-recession is really the first time in history that this has happened. And here you have the unemployment rate being down where it is now, and yet we have this surging budget deficit, means more pressure on treasuries, on the treasury markets. And then you have foreigners who are stepping away from treasuries where a few years back they had owned as much as 60%, and now they're down to 45%. So who's picking up the slack now at a time when the treasuries, when the borrowing needs of the United States government is growing very, very rapidly? Who's buying that stuff? Well, the answer is that since 2015, it's been almost totally purchased by 4 major banks, and they've been using their cash to buy treasuries. The 4 banks, J.P. Morgan, Bank of America, Citigroup, and Wells Fargo. As Eric explained yesterday, the primary dealers have an obligation to buy treasuries to essentially make a market in the treasury market. But the only big players that are big enough to buy these, have been these major banks to buy the quantities, since the Chinese have stepped away, and the other net credit nations, the nations that have run export surpluses, have stepped away. Who's going to buy the treasuries? And for the longest time, in America, we got away with the idea that we could live beyond our means as long as the foreigners would continue to finance our deficits. And that seems to be coming to an end. So what's happened in the repo markets recently, you had the banks, as I said, the big banks, had basically spent all the cash. They drew down their cash levels to buy treasuries to the point where it was dangerous. They couldn't do any more. They couldn't go beyond this point, this line in the sand that's drawn on the slide. And so they've turned to, and so the rates had started to go up. The repo rates went way, way high. And the Fed had to step in and start printing money. So no QE, well, they don't call it that, but through the repo market, it looks like it could be a permanent kind of a situation. Where is the financing going to come at these interest rates? So one answer would be to let the interest rates go where they need to go to get all of us out here buying U.S. Treasuries. That happened in 1979 and 1980. I remember it very, very well when my first mortgage was a 17.5% mortgage. Yes, Volcker came in and gave reason to own the dollar, but now there's no reason to own the dollar. There's no reason to own the dollar essentially other than for transactional reasons. But the real problem here is debt is growing much more rapidly than income. If you had the income, the GDP that was coming out of the debt, if it was growing at the same rate, there wouldn't be a problem. But this is clearly unsustainable. Recently, there were rates of about 6%. This slide was at the end of December, but they've recently gone up higher, something like closer, they went up to around 6%. The issue is that the liquidity issue has not been resolved. In fact, since December, as you can see here, this shows the shortage of liquidity shortages have really risen since the start of the new year. This is the revenue IRS revenue slide showing that even when we're in this bull market, or in this, according to Trump, the most wonderful, greatest economy ever in the history of human beings, we're still seeing this in terms of revenue growth. Of course, part of that is his tax cuts, which explains part of the reason why we're not seeing a growth in revenues. Accounting firm here has done a survey recently and come up with 97% of U.S. CEOs believe that we'll head into a recession. Actually, that slide isn't quite right. It's a recession or a decreasing growth in the economy. But anyway, it's pretty significant, and this explains why the CEOs are buying far less of their stock right now. And the CEOs, by the last I looked, were pulling huge amounts out of the market, probably after they bought their stock to pump it up so they could exercise their options. Anyway, this slide shows that whenever you have this inverted yield curve, you can pretty much bank on a recession. So now if we're heading into a recession next year, this year, or in the near future, at the same time the treasuries are running these huge deficits when we're supposed to be in the best of times, what's going to happen to us? Where is the money going to come from? How is it going to be financed? How is the budget deficit going to be financed? We're pretty sure, as Michael said, we know how it's going to be financed. The Treasury, the Fed has no choice but to print. This is a very interesting slide because it's one I want to watch. I think it's interesting because you'll remember when gold hit its peak in 2011, towards the end of 2011, the Fed did Operation Twist. They essentially sold short-term treasuries and bought long-term treasuries, pushing the long-term interest rates down. Why would they do that? Well, one of the reasons that gold rises is because people worry about inflation. And if the long-term treasuries are going down, then that's telling everybody, oh, hey, you don't have to worry about inflation. It's not a problem. And Wall Street certainly liked that idea, and they bought right into it. Michael's chart, now by the way, he does this, he always does this, the bottom chart is a momentum chart, the top chart is a price chart, and he pays more attention to his momentum than he does to the price. Everybody else pretty much watches price. But what I've found with his work over the years is that his momentum is his structural momentum, when the structure is broken, then that's when significant changes occur. And so I've really had a great deal of faith in Michael Oliver, but he doesn't see any issues at all in structural dangers here. So he's extremely all in basically as a bull for gold. And as far as T-bonds go, as he explained in his remarks to me, well, he thinks we're starting a long-term bear market in treasuries and interest rates. We're going to see interest rates rise no matter what the Fed does because of the dynamics I just talked about. So he's watching the T-bond market, and if the commodities start to rise dramatically and people start to believe that we're in an inflationary market, well, maybe the Fed will try a twist again. That's one thing I want to be aware of because it just murdered me and a lot of the gold shareholders and the gold bull, from $1,700 to nearly $1,000 in the gold market, so it was pretty devastating. And again, this is a pretty recent chart showing the commodity complex where it is historically, as Michael said. Just look at a chart. It makes all kinds of sense to buy commodities at this time, and probably not stocks. Now, this is the gold price measured by FMQ, that stands for fiat money quantity, and it's an Austrian school construct, and it's basically it has to do with deposits and deposit money and cash. So this just shows where gold is, and this is also at the end of last year. So gold is really about as low as we've seen it. What about gold or the miners? Well, recent work that Michael has done shows that the miners, the XAU he uses, probably not all the little juniors, but the more established gold companies have really broken through. And so if it's a question of gold or gold miners, at least the upper tier ones are now outperforming, and he would suggest for some time will continue to outperform gold bullion. I just like to show this chart. This is the one I've tracked since I worked at ING Bearings in the metals and mining department. I like to look at a monthly price for gold rather than daily stuff because you get lost in the emotions of the day-to-day stuff. So this is a monthly chart showing the 20 and 40 week moving averages. To me, this is just a screaming bullish chart from what, I'm not a technical analyst, but certainly seems like we're in a bull market to me. All right, so now we're going to talk to the people that really make it happen and find gold, find money, mine money in the ground. Somebody was saying the real bankers are these guys that discover monetary metals, gold and silver in the ground. So we'll start out with Peter Talman of Klondike. We got Klondike and Radisson Mining Resources are the two that I invited here. And then North Star Gold and Prime Mining Corp were invitees of Gwen, but Gwen has so many companies she'd have to give 3 speeches if she had all of her companies come up here. So it's like the rich helping the poor, I guess. All right, so let's...